We're getting ready to jump into lesson 2, credit scores. And today's objective for understanding credit scores is you'll be able to understand how credit is calculated and how it effectively maintain a good credit score. So you may say, well, credit scores, maintaining, how do I do all of that? Well, no need to worry. I got you covered. And we're actually going to dive into, first of all, ultimately what makes up a credit score. See, a credit score is really just an algorithm that is calculated over, like we learned in lesson 1, the ability to make payments on time over time. So in understanding a credit score, first we need to understand that our credit scores is really just, or as I call it, your credit profile. See, your profile is going to be the components that makes up a credit score. Some of you guys may be more familiar with, the whole pie graph. I'm just going to break it down to us because I'm also going to dive into each one of those components and elements. And by the time we go through and break down each core component of what makes up a credit score, as I say, how to get the perfect credit score. When you follow and understand what makes up a credit score, or how to build the proper credit profile, the score will always take care of itself. So no matter where you are with your credit right now, personally, you may still have a lack of understanding about what is credit as far as from a credit profile standpoint. But once we break down each core component of what makes up the actual score, you'll have so much more knowledge of improving your situation no matter where you're at. So whether you're at a 400 or you're in a 700 and eventually want to get to an 800, like we talked about, the credit score ranges from 350 to 850. So by following these simple core components of what makes up the credit profile, you put yourself in uncharted territories to where now you are always going to be able to have access to having good credit. Because the thing about understanding that is that going through life, life happens. You could potentially have good credit for most of your adulthood, and then something happens and your credit score drop. But once you understand what makes up the profile, you'll always be able to repair it. So let's go ahead and dive into it. So the first component of what makes up your credit profile, and you'll hear me say profile a lot because a credit score is just the score. It's just the 3-digit number, as we talked about, from 350 to 850. I want us to focus on the profile, what makes up the credit score. And so with the first one being our payment history. Now, each component has a certain percentage of what makes up your credit score. Payment history makes up 35% of your score. This is actually the largest component of what makes up our credit scores. So now, going back where it's to make payments on time over time, you want to make sure that you're making your payments on everything that impacts your credit score directly. So you have first of all, let's go into the different types of credit, and we'll dive a little bit more in depth to that in the later lessons. But you have what are called installments credit, and then you have what's called revolving credit. Okay. Both of those have a payment amount that you have to pay. Now, by not making your payments on time, you now decrease your payment history, or what makes up your payment history. Again, 35% of our scores are based upon payment history. And so one late payment can drop a credit score as much as 50 to 150 points. Now you may say that's a huge drop. Of course, that's because your payment history is the highest percentage of what makes up your credit score. And also, did you know that the higher your score is, the more that late payment affects your credit, the higher your credit score is. So if you have a 700 credit score or a 750 credit score, your score could drop to a 600, which is bad, literally just by missing a $15 credit card payment. See, when you have payments, I always recommend that you put your bills on what's called Autopay for at least your minimum payment. Meaning, you have a credit card, and let's draw this out because I'm a visual person. Most of us are. So you have a credit card. Your monthly payment is, let's say, $15 a month. Okay. You want to put this on auto pay so that way, no matter what happens, this bill will always get paid. Because like we established earlier in this lesson, life happens. You're on vacation. You're at a wedding. You're at a graduation. Whatever it is. You may be out of the country for 2-3 months, and if you're waiting for that statement to come in the mail every single month, but you're on a European vacation backpacking across the world, how are you going to make that $15 credit card payment? So yes, you could go online manually and pay that bill, but sometimes you may be in an area where you may not have access to it, and you may have potentially missed the due date. And so by missing that due date, understanding you potentially just dropped your score 50 to 150 points because you couldn't send in that credit card payment. But when you set your bills up on Autopay, those bills can get paid in spite of where you're at, what you're doing, what your situation is, or anything that could potentially prevent you from making that credit card payment. Now, some people may say, well, I want to pay more than a minimum. That's completely okay, but at least you're setting your auto pay up to at least make the minimum payments, because by at least making the minimum payments, you ensure yourself to have great payment history, which again is the highest component, the largest percentage of what makes up our credit profile in order to get us in position to have the perfect credit score. See, I'm not going to talk about just how to get a good credit score. We're going to talk about have a perfect credit score, because these simple disciplines over time is what's going to put you in position in order to be able to accomplish that goal and having a strong credit profile. Because see, when you are going out there to borrow money, banks lend you money based off of your payment history most of the time, not even necessarily just your credit score. Prime example, car dealerships. Did you know that there's a website called myfico.com where you can go and pull your different FICO score for your auto, home, and credit cards? There are different FICO scoring algorithms to determine how they'll loan you money and lend you money for these different things that you potentially will be applying for. So in relations to an auto loan, the reason why you can still purchase an automobile with the subpar credit score is because as long as they see that you've had good payment history, regardless to what your credit score is, when you get ready to purchase an auto, your auto FICO score will potentially be higher than your home and credit card score. For credit cards, they use what's called a FICO 8, which is just the scoring model. And for those who don't know what a scoring model is, it's different ways on how they gauge your credit worthiness depending on what you're applying for. And so when it comes to your auto, your payment history dictates more so on what they'll approve you for. Now, they can cap your approval amount, and even if you have great credit, but you've never financed a vehicle before, because of your lack of payment history, they can still cap you. So your payment history is extremely, extremely important in relation to what makes up your credit score, your credit profile, because they're looking at your credit responsibility. Going back into the acronym of credit, you have to be responsible in making your payments on time. And when you're not responsible in making your payments on time, hence, you could potentially drop your credit score 50 to as high as 150 points. So now, next, what is the next component of what makes up your credit score? You have what's called your credit usage. You may ask, what is credit usage? Your credit usage is your balance versus the amount of credit lent to you. So the amount of credit that has been loaned to you based upon what you're actually using, only in relations to revolving credit. So, of course, don't worry, I got you covered. I know what you're thinking. I don't even know what the difference is between installment and revolving. So, as promised, installment credit are anything that has a fixed payment. So, if you have a fixed payment, it is an installment account. What could be an installment? You have your home mortgage, auto, student loans. Those usually have a fixed payment, meaning whatever you borrow, you pay that amount back every single month. Or you have what are called revolving accounts or revolving credit, which has a revolving balance, meaning you're only paying back against what the balance is of that particular card. And generally, that's only for credit card and department store cards. So store cards, all right? And so let's say you have $1,000 credit card and you use, $500, okay? Your payment may be $25. But as you pay down into that bill, into that balance, and you get down to where now you only owe $250, your payment could decrease to $15 a month. So your payment decreases. as your balance decrease. That is what revolving credit is, okay? So now your credit usage, going back to credit usage, is only based upon revolving credit. And how does that impact you? Well, first of all, your credit usage is 30% of what makes up your credit score. The second largest component of what makes up your credit score is your credit usage. So just those two combined makes up 65% of what our credit scores are. So understanding, if you can just master paying your bills on time, if you can master credit usage, you've already put yourself so far ahead on how to improve your credit score. See, a lot of times when we sit down and meet with people in relations to educating them about credit, them understanding credit, them improving their credit, a lot of times it's not the fact that they have bad credit. A lot of times it's the fact that they don't pay their bills on time or that their credit usage is too high. What does that even look like? So going back to that scenario, you have a credit card, $1,000. You use $900 of that credit card. I'm so used to writing percentage. You guys got to forgive me. So you now have used 90% of your credit card, which is impacting your credit score drastically, because to have an effective credit usage in order to where it does not impact your credit score as much, you want to be at 30% or less. Anytime you go over 30% of your revolving credit lines is going to drastically impact your score. The further over 30%, 50%, as much as 90% can drop your score drastically. And so if all you had was one credit card for $1,000 and you're using $900 or 90% of it, it has definitely, impacted your credit. But that could be the difference in having a having a 700 credit score to as much as a 500. I've seen credit scores drop just based off of having 90% credit utilization. Now, the reason I'm stressing this so importantly is because a lot of times when people are trying to improve their credit, most of the time it is because they have overextended themselves on the credit because of the lack of education that they've had. Most people don't know that their credit utilization impacts them. So how do we figure out what our credit utilization is or what's a healthy balance? So any revolving credit amount you have, you want to take that and you want to divide it by 3. So when you divide that by 3, that $1,000, you already know that 30% is approximately about $300. Of course, a couple odd numbers in there, but just for the sake of math, we want to keep it, which is 30%. So anytime you have $1,000 worth of credit, you don't want to spend no more than $300. But because now you understand, if you do go over 300, paying your bill down, you already know it's going to increase your score again. So what do? This is why I tell people understanding credit is a lifeline, and also understanding that at minimum, you should have access to at least $10,000 worth of revolving credit. Why is that? Because we understand life can happen. Imagine, having to get your brakes done and you don't have the actual liquid cash and you need to come up with $700. Now, if all you have is $1,000 and you use $700, you're now at 70%. What does that do to your credit score? It's going to drastically impact you. But if you have access to at least $10,000, and again, this is of a just in case of an emergency credit, and you need to borrow $700, now you're only at 7%. What does that do to your credit? It doesn't impact you as much. So because of our lack of education, or for those who have been taught that credit is bad, credit is no good, don't get those credit cards, you're doing yourself a disservice, because understand the lack of having access to revolving credit, i.e. credit cards, you put yourself at a disadvantage in emergency scenarios. I've talked to people who've only had $300 credit cards and needed to come up with $500 for an emergency. And so some credit card companies will let you max that card out, but now you're over 100%, drastically impacting your score. So again, my rule of thumb is you always want to have access to at least $10,000 worth of credit to be able to put yourself in a position in case of an emergency. So if you do need to borrow $700 for those breaks or whatever the case may be, you only are using 7% of what makes up your credit score. So again, those are the two largest components of what makes up your score. There's 3 more components, which, we're definitely going to dig into and dive in. But the reason I spend so much time on those 2 is because, again, it makes up 65% of what makes up your score. But more importantly, just those two components alone, you can not only increase no matter what your credit situation or scenario is, your credit education or astuteness is, but if you are in a scenario where you need to repair, rebuild, or restore your credit, if you just focused on those two items, that's 65% of the battle. And so the next thing of what makes up your credit is your length of credit history, meaning a good age of a credit file makes a big difference. What do I mean by that? Meaning that if you're always constantly going out there just frivolously applying for things, credit cards, automobiles, just because you like the thrill of applying for applications. If you got bad credit, maybe you like the thrill of getting a denial, because ultimately that's what will happen. It is going to impact the length of your credit, the age of your credit. And this makes up 15% of your credit score. Not as much or as high as the other two, but it still has an effect on your credit profile, especially if you're teetering right at the fair or, credit score, right? Hovering around like that 650 to 680. Going out there always frivolously putting in applications can impact your credit score. So you want to make sure that you're not just always constantly going out there. Now, if you're in a scenario to where you're trying to, get financing or funding for your business, most banks want you to have an average age of file of 5 years or more. Now, if you have less than 5 years, will that minimize your chances of getting approved? No, it doesn't. If the rest of your credit profile is healthy, but it could impact the amount that they approve you for. So understand your length of your credit history does make a difference. Now, that's only when it comes to going after revolving credit. When you understand how bank underwriting works. Now, when you're trying to purchase a mortgage or auto loan, those things don't impact you as much, the age of your credit file. But the lack of an age of a file is also impacting your score. And the reason this is so important is that I get a lot of people who have a 700 plus credit score. And I always tell people, or people always ask me, man, I want to get to an 800. And I tell people every day, if you have a 720 or better, you're going to get pretty much the same rate to someone with an 800 score. But aesthetically, just having an 800 looks good. It's good for bragging rights. Could be a good conversation piece when you're out on a date. You want to impress someone. But more importantly, how do I get to that 800? People always ask. And a lot of it boils down to your length of history. So if you have recently gotten into like that 750 and above and you can't quite crack that 800, just continue to make your payments on time over time. The more you season your file, the longer the length of your credit history becomes. That's how you get to that 800. There's no magic potion or secret sauce that you need. You just gotta, have a little bit of patience, as I call it, in order to be able to get to that 850. So we got length of credit, 15%. Next is our mix of credit. Mix of credit is meaning you have a good, healthy balance. What's a good, healthy balance? Credit cards, home and mortgage, auto loan. You have these components on your credit file. This is what's going to give you a much more healthy credit profile, which also makes up 10% of your credit score. Now, in relation to, and you're going to hear me talk a lot about intermittently your personal credit, and if you are trying to get capital for your business, which also your personal credit impacts, what underwriting guidelines look for in a healthy credit profile is they're going to look for a good mix of credit. The 10% from a credit score standpoint, but it can heavily weigh or sway the bank's decision in how much they approve you in relation to applying for credit. Because keep in mind, banks want to deal and loan and lend money to individuals who have been responsibly paying them back for a long period of time. Think about it from a personal standpoint. If you knew somebody for 2 weeks, would you loan them $1,000? I didn't think so. That's the exact same way banks look at us. See, anytime we have a question when it comes to loaning and lending money from an institution, a financial institution, let's think of ourselves as if we were the bank and someone came to us wanting to borrow money. I would not feel comfortable loaning somebody $5,000 and only knew them 3 years. I don't know their financial situation if I didn't, really grow up with them or we're not doing business together. I don't know their spending habits. I don't know how financially responsible they are. Have they not paid other people back? All these different things, essentially, that's what someone's credit score look like. I typically don't loan money personally to family members or friends with bad credit, because if they're not paying their creditors back, why would they pay me back? So the same thing applies when you're dealing with banks and how they lend money to us. Your mix of credit plays a major role in the approval amounts. The approval amounts, not necessarily the approval, because you can have a 700 plus credit score but don't have a mortgage. Does it mean you'll be denied anything? No, it doesn't. But on the latter end of it, you could not have any credit cards reporting and still have a credit score, but your credit score actually could be a lot less than a 700 because ultimately you're missing what makes up 30% of what makes up your credit score. So understanding by having access to this information, following these components of what makes up a credit score, again, not only do you put yourself in a position of building the perfect credit profile, but you open up so many different doors and opportunities from a lending standpoint. And then the last component of how to get the perfect credit profile, we're going to stop using scores. We're going to say credit profile is new credit, which is also 10%. Now, you'd be surprised. I talk to so many people when they get approved for something new, man, it's like they won the lottery. It's exciting getting approved for something. You know, you get that new vehicle with a 3% interest rate. You're excited. You know, you get that new home. You get that new $20,000 credit card. Now, understanding, and I say these things kind of jokingly, but in relations to new credit, again, going back to the philosophy and the mindset of dealing with credit and us being taught that credit is bad and having credit cards are bad. It's not that credit cards are bad. It's people who are irresponsible with money that makes credit bad. You know, as I say, I know people who have, been irresponsible with their checking account, overdrafting their bank account and overdrafting multiple banks. They've taken advantage of so many banks in their local area that they had to move to the town next door, bank that didn't know them. So understanding it's not the credit itself that's bad. It's not the credit card itself that's bad. It's the lack of education, the lack of responsibility. Again, going back to that acronym of what makes up credit, that makes credit bad. So understanding that and knowing that a portion of also what makes up your credit score is 10%. Now, there's a caveat in dealing with new credit. We have to understand that a mixture of credit or our length of credit plays a role. So we want to make sure that we're applying for new credit in a calculated format, meaning we're not out there frivolously. We're not out there just on an application binge, as I call it. And so when it comes to new credit, same thing, credit cards, home, auto, all those different things. Now, some of the other things that you do also apply for, like utility bills, your gas, electric, heat, water, all those things. Yes, those companies will run your credit. It doesn't impact you from a credit payment history standpoint unless you go delinquent, but it can impact you if you have bad credit when trying to apply for these. So understand those things do play a major role. And then also in relation to new credit, one of the pitfalls when you don't understand the rest of your credit profile is you could potentially deal with what I call credit inquiries. You have what are called hard credit inquiries, which essentially a credit inquiry is anytime you go to apply for credit for the purpose to be extended credit. That's a credit inquiry. Meaning if you go to a dealership, you run your credit, that's going to cause a hard credit inquiry, which again, those inquiries can make up as much as 10% of your score. So understand, when you have bad or challenged credit and you're frivolously going out there getting a bunch of hard inquiries, it also is going to have a negative impact as much as 10% to your score. So 50, you have a 600 and you're just going out there racking up a bunch of these hard inquiries, you can have as much as a 60-point drop in your score. Again, what you don't know can hurt you, which is ultimately why, you want to go out there in a calculated format and apply for new credit. So just kind of giving you a recap of how to make up that perfect credit score. You have payment history, which is 35% of our score. You have credit usage, which is 30% of our score. And we know these are the two largest components of what makes up our score. We have our length of credit, which is 15% of what makes up our score, meaning how long are you, your average age of account, your oldest account, all those good things. You have mix of credit, which is 10%, meaning a good mixture, home, mortgage, auto loans, et cetera, et cetera. And then we have new credit, making sure that we're responsibly applying for new credit, responsibly, having a good, healthy mix, responsibly using our credit usage, and of course, the responsibility of making our payments on time, over time. So this is how you develop and build a perfect credit score. Knowing these things could be the difference in you going from a 500 to a 750. Also from going from a 750 to an 850. Just, having a little bit of time, a little bit of patience. And of course, the secret sauce is understanding what goes into making up that perfect credit profile. So again, guys, my name is Will Roundtree, and I will see you guys in lesson 3.